lecture even later. She's an BI consultant with over 9 years of experience in developing decision support systems, scoring models, and ETL processes in banking and telco. She gained experience by working in top 3 of Croatia's largest banks on projects in risk, credit scoring, and DWH. Her main interest is related to the fintech industry and applications of data science and big data technologies. In her today's speech, Digital Footprints in Credit Scoring, she's going to tell us how everything we do counts towards our credit score. Having a clean balance sheet is not only the thing that is important nowadays. His lecture will give you an insight into business and technical perspective of new possibilities on how to create more accurate credit scoring models by using new data sets and somewhat maybe untraditional approach. So, very interesting lecture is coming on, but before that, let's just see the video of our conference and our next partner. Just use the opportunity to talk since it doesn't have no sound, so we're going to do this a bit more quicker. Let me interest you in our next partner, Koios. They're a leading company in the field of analytic systems implementation and custom application development, and they specialize in implementation services for data warehousing, big data analytics, data integration, business intelligence, and custom development. Their distinct experience is mainly in the banking industry, in all business areas ranging from IT over risk, compliance, regulatory, reporting to sales and credits. Koios is currently helping most of the Croatian banks with the transition to euro, also developing a fintech app for UK customers, helping US companies with their financial reporting, supporting the biggest company in the energy sector in the region with their internal processes, just to name a few. We would like to thank Koios for partnering with us. And since the video is over, I'm finally giving the word to you. Thank you. Welcome here on the stage.
Hi, thank you all. My name is Kristina. I'm from Koios Consulting Company, and I will talk something about digital footprints in credit scoring. Just to check the pulse of my audience, please raise hand if you come from banking or fintech industry. Okay. And please raise hands if you develop credit model ever. Okay. Thank you all. This talk was intended to be beginner to intermediate level, but I'm sure you will find something interesting. Maybe I can plant some new ideas or give you a little different perspective on credit modeling. So, I will invest some time in proper introduction to give you motivation and explain what is the problem currently in credit scoring. And to do that, let's just open with some quote from a group of authors, and I just read it to you. A key reason for the existence of financial intermediaries is their superior ability to access and process information relevant for screening and monitoring of borrowers. So, financial intermediaries are traditional banks, but if some new players come around and they can do the same as bank does to make lending decision, they are really disruptors and can compete on the same market, lending business. And there are some questions. How good are our predictions, how much they cost, and how quickly we can make lending decisions. There are two main development areas to address those questions. One is better models, and other one is the new data. I will just quickly go through this better model approach. Today, we have machine learning, artificial intelligence that beats traditional statistical models like every time when it comes to credit scoring. But logistic regression remains the standard in banks. And why is that when we have such new stuff? Well, there is much of regulatory supervision, and machine learning and artificial intelligence methods lack explainability. So European Banking Authority calls for discussion on that, and this was meant for banks to join in open topic. But for fintechs, regulatory is not so strict as for traditional banks, and this is somewhat uneven playing field. And other approach is new data, and those are the data sources for credit scoring that could be available. I will focus today on digital footprint data, but borrowers can take a look in your social media or can monitor your clickstream on the web pages. How do you answer their survey? They put them for you. If you are writing a lot about soul or spiritual stuff on Facebook, this could affect negatively on your credit score. And this is no kidding, there is actual research on that. The other hand, I would like to just give you examples of some new players on fintech who completely disrupt the standard banking business. Lending Club, the world's largest lending platform. Today they are bank holding, but they certainly did some game changes in their time. The other ones from China, maybe you know some of them. Alipay is an affiliate company from Alibaba Group, and today it is the largest fintech in the world. And WeChat, as some of you know, as Chinese social group, but it's actually a lot more. You can lend money from that platform. And finally, Slovenian company, present in Croatia since November last year. You can buy stuff online or in regular store to amount up to 20,000 kunas and pay later in 24 installments. And some new data, alternative credit scoring, is what companies use and what they do. Just to go quickly, what was happening over the years with FICO score and Lending Club rating rates. Everybody knows what a FICO score is. This is the most popular credit score from private credit bureau. And Lending Club, I was mentioned before, was a fintech for peer-to-peer lending. It was obvious that correlation between scores was dropping through time, and there were some additional metrics beyond FICO scoring that Lending Club was using. And as you can see through times on these plots, what was that Lending Club was having and FICO was not? Well, this new alternative data. And recent post from FICO blog shows that if they include this alternative data characteristics in their traditional variables, they can build better models with better performance and give some additional predictive value. And finally, I'll come to introducing digital footprints for credit scoring. Digital footprint is simply information that people give online, but just by accessing or registering on the website, like your device characteristics, some typing patterns, your email, website cookie data, and so on. Fintechs have superior ability to process these digital footprints, and those digital footprints cost almost nothing to collect. I will I will now present the showcase of this group of authors I already quote, and their study on the rise of fintechs, credit scoring using digital footprint, and how they came to some groundbreaking results in this area. They developed 10 variables for digital footprint, and I just list them here for you because names are quite explanatory, and some of variables are devices, channels, other are from emails, and some variables are derived from, let's say, some event like input error when you enter your email or when you check out your purchase. Data was collected from an e-commerce company in Germany, and they were combined with private credit score bureau credit data, and there was some percentage, 6% of the sample, they didn't have a credit score. We call that unscorable customers, because Credit Bureau didn't have any input to calculate their credit score, and this data was largely representative either of the population and of typical customer loan. What was interesting in explanatory analysis, that some variables can act as income and wealth proxies. Let's say if you have an iPhone, you can consider yourself a wealthy person, and we know that you are accessing our web page through iPhone device, and it shows that you are less likely to default than someone who uses Android device. Also, if you have a paid service email, you are less likely to default than someone who uses Hotmail or Yahoo email. Let's move on to character proxies. This is interesting and quite common sense explainable, that customers going to web page to pay ads are more likely to default than customers who done their research and come to our page from affiliate site, let's say price comparison site. This is understandable because those clients can be seduced by those ads and overestimate their paying ability, or they have instant shopping personality traits. And for all grammar maths here, grammar matters. If you type everything in lowercase, you are likely to default, so grammar nuts have a better credit score, be proud. And for proxies for reputation, it shows if someone have a number in their email address, they are more likely to default than someone who have their name or their surname in email address. And this was particularly predictive for fraud, since fraudsters used some email they opened 5 minutes ago and use some generating username. What is important to note here, that variables can be proxies for several things. Let's say owning an iPhone device can be proxy for wealth, but also can be proxy for status-seeking individual, and maybe some characteristic of that. This have nothing to do with model performance, but it is important to that you can understand and interpret your data and connect with existing marketing research on those findings. And finally, the results. This is the AOC plot. This is standard measure of model performance and model goodness. It is literally how percentage under the curve of this one-by-one box. If you are new to this AUC, you can ask me later. I will gladly explain to you in details, but for now I will like you to concentrate on credit bureau score model and digital footprint model. Their AUC are almost the same, which is quite extraordinary if you think, because our credit digital footprint variables were very simple, very naive, and credit bureau have all the data about your account balances, about your credit history, about your behavior, about your payments, and we can match that just with those digital footprint naive variables. What is really important here to notice that third model, which is combined credit bureau score and digital footprint model, outperforms everything, and this is really power of digital footprint that act as a complement to standard credit bureau score. Correlation between two datasets was about roughly 10%, so it is really a supplement, it's not redundant. What is important to notice here is that all these models are just plain old-fashioned linear logistic regression. There is no machine learning fancy stuff here, and this is very applicable for traditional credit scoring in banks. Conclusions, I'll just leave some reference here for you if you are intrigued. Look at this log data research, and interesting for bankers here, we can have same results and same conclusion when we change the definition of default. Maybe I didn't say default is financial terminology that is simply a situation when somebody cannot repay their obligations, and we can change that definition to interest. We can be asking ourselves how much money will loss if somebody goes to default. This is LGD, loss given default problem, and that results stand for that definition as well. What is important here, if you remember those unscorable customers that didn't have a traditional credit bureau score, is that we can assess them through digital variables, and this have a very economic and social impact. Why? Because there are 2 billion working age people in the world, particularly in developing countries, and they don't have access to financial services, they don't get finance. So fintechs have an opportunity here to use such models to give those billions of unbanked people access to credit and to, of course, make money on those emerging markets. And the World Bank recognized those problem as important, and they say that financial inclusion is key for reducing poverty and boosting prosperity in developing countries. We can ask ourselves, can digital footprint predict future credit score by traditional credit score bureau? And the answer is simply yes. It means that a good digital footprint today can result in increase of the credit bureau score tomorrow. And this is a window for traditional banking world, because digital footprints are applicable to other loan products, not just retail portfolio of unsecured loans. I listed some companies that use digital footprints today. I'll give you a few moments just to absorb recognize the name. And what is interesting here is that users of online credits are usually younger people, millennials, Zgens, and they are very comfortable with technology, and they like to mix their lending with online social services or even dating services. So, if you didn't know, credit score dating is a thing in USA, in China, and you can try this out if you want to have match with partner who have similar credit score than yours, or you can just launch this service in Croatia. Why not? Some implication of using digital footprint for behavior of customers. When it comes to digital footprints, we must be careful about customer behavior because they could easily change their intrinsic habits. It is costly to buy a new iPhone and to go to web page with my new iPhone, but I can not having night shoppings as they are predictable for default, or I can pay attention what I'm publishing on social media. It is important to have that in mind, and this can have considerable impact on everyday life with customers continually concerning their digital footprint. On the other hand, there are some implications on behavior of firms and regulators. Firms can decide to conceal their footprint, especially if they are connected with low creditworthiness, and we can expect to some businesses that will help to conceal that digital footprints to emerge. Also, if I am a producer of high-end Android mobile phones, I would like to distinguish myself from those low-end problematic mobile phone producers. So that could be something to think about. And from the regulatory point of view, there are some things that are legally prohibited to use in credit score modeling, such as race, gender, nationality, religion, and fintechs must be very careful with that. They will not use proxies for such things. Also, we can expect to certain groups to lobby for prohibition or scrutiny of those digital footprint usage. And I will just conclude with my 2 cents on the subject. You can remember those unscorable customers and how did digital footprint can overcome information asymmetries between lenders and borrowers. That is an opportunity for traditional banks. As well, they could improve their credit scoring for fintechs especially. But really, every digital firm that operates on buy now and pay later business model can benefit from using digital footprints in their scoring. So I would encourage you to collect some digital footprints from your web pages, and even more to look at your already existing log files, log records, and try to find some new value there. Because I think it has a strong and predictive power for your credit scoring or for risk assessment of clients as well. And that's all. Thank you all for listening. I have, I think, time for one or two questions, but if you want to ask me something, you can find me at our Koios stand and we can exchange some ideas.
We have one question in the first row. Our mic is coming, and for you, one certificate of appreciation. Thank you so much.
Thank you for your presentation. And I just have one question regarding the area under rock curve slide. So I was wondering, how are you measuring the model performance after it's in the production? No, I'm not asking about the specific metric. It doesn't matter if it's precision recall or area under rock, but just how do you monitor it? How do you know that your model is performing well?
This is a scientific paper.
Okay.
This is a scientific paper that is not mine research, but they monitor, it is in production, but I don't know the details how they monitor.
Okay, thank you.
No problem.
That's all.
We have one more, as I can see.
Yeah, I was wondering regarding the digital footprint data, how readily available are those data to, for example, banks to get from customers? For example, for myself, I understand that I can access my digital footprint, but how can a third party access my digital footprint data to evaluate my credit score?
I think I understand the question. Banks has loans online, and those are applications when you have to register, you have to input some things, and those are the web pages that could collect your digital data. This was from e-commerce web shop. They collect their own data, and they have a credit score bureau credit scores. We don't have here in Croatia such service. We have KROK, which is similar, but credit scoring for customers is internal rating for each bank. It is not shareable with third parties.
Thank you.
Okay. Do we maybe have some more? No? Okay, we do have one more. Here, at this part of the hall.
So it's in line with the previous question. So I'm from telecommunications. So we have a really strict policy of gathering data from our customers and related to the digital footprint and everything. We have to have a strict and I would say a detailed defined consents to be able to collect data. And it's not only consent for collecting the data, or also there is also GDPR area which is related to the right to collect data at all. It's not related to the consent. For example, location data is really problematic and stuff like that. And in line with also one other thing, you mentioned that some features are not able, or attributes, and we are not able to collect such as gender and stuff like that, but a lot of things could be proxy for something.
Yes.
And we know that from a couple of attributes we can create another attribute, we who are working in data science and everything. So how is this applicable at all? Because I know that regulators will not allow any of this for us to use if it's not coming from our system. Because one thing is to collect from the website, but the other thing is when you are installing certain application on the smartphone, this application can collect much more, which is apart and outside of logs that are collected by the application itself.
You are correct. Here in Europe, we have a strong regulative on such things that we can collect. And mostly these lending online platforms comes from China. They are a little less, more or less regulative, and from USA. But if you have a web page when on which customer have to input their email address, personal contacts and bank account. Link paying uses bank account. You must click I consent and you are okay with that. But in this, let's say gender variable, this could be very predictive for something, but you have to be very careful with that. Somebody could ask you why. And you are in risk to discriminate on that thing.
But I just said that a lot of other stuff would be...
Of course.
There,
other
if you have time,
topic.
so one example, which is in USA, they are not allowed to use addresses in their models which are related to the convicting certain crimes, because they are almost every time related to the poor areas. And they say, okay, this is discrimination, we will rid of it from the model, but they then create another problem. They're just avoiding it, but the problem persists. So,
let's say China is another world.
yeah, I know. And as far as I can see, a lot of footprints, the data here is
yes.
from AliExpress and stuff like that. Yes.
AliExpress, Korean bank, Kakao bank did look, but we did some inquiry with some of our Croatian banks are looking into their log data and use it as a digital footprint to improve credit score. For telecoms, especially web pages, web shops, and some, let's say, application could collect some kind of digital footprint with consent.
Yeah, I agree. Thank you.
Thank you.
Do we maybe have some more? It's nice to see that this topic interests you.
I was wondering, since probably this is still not regulated enough in Europe, but banks can use their internal services or some internal models to make preconditional, let's say, like models for pre-approving some loans or something like that. So I was wondering, they have the flexibility there not to use just scorecard models, but they can use any kind of models to make pre-assessment.
That's
they
right.
can, yeah. So would it be better then to take into calculation some machine learning models that are based on conditional probabilities? Like you already said that most of those digital footprints data are left by younger users. For instance, if my mom had to use her iPhone, no matter how wealthy she is, she would probably kill me. So my question is, would it be better then to make some conditional probability machine learning models based on that digital footprints that is based on users that are younger, for instance, younger than 40, and then to make better assessment? Because I saw in your graph, for instance, when you were describing the raw curve, that the accuracy for digital footprint data and classic credit bureau data is about the same, but when you mix together those two, you don't get such higher accuracy. It's maybe 2-3% higher. So maybe it would be even more higher when we would base it on that kind of models for reassessment.
I just simply answer your question. If you have age among your digital footprint data, you will crazy not to use it. It is highly predictable in such things, if you have it. But when you come to a regular web shop, it is not very common to leave your age there. But if you apply to some, let's say, features or some newsletters, you can enter your birth, you can enter your date of birth, and so they have all of the needs. So it is it is also a thing for designing a web page and for users and to collect their data. Banks have that data. Banks know how old are you and who the target is for their products.
Do we maybe have another one? I think that's it. Kristina, thank you so much.